Hey, what's up, everyone? Welcome back to the Path to Freedom podcast. Today, I'm joined by Jody Grunden, who is the founder of Summit Virtual CFO by Anders. We were chatting earlier, his company. You started this, back in the early 2000s, Jody?
Yeah, about 2002, actually. Yep.
And been through a few mergers and name changes along the way. But Jody, welcome to the show, man. I'm glad to have you here.
Yeah, thanks, Wes. Appreciate it.
Yeah, we were just chatting a little bit offline, and I think there's a lot of interesting topics that we could kind of get into today. A ton of value that you can bring to the audience. But to kick it off, maybe just give us kind of a quick overview. You know, what is Summit Virtual CFO? What do you guys do? Who do you help? And then I know you've got a pretty incredible backstory too. You know, of how you started this business 20 plus years ago and have built it to where it is. So I'd love to pull from some of that as well.
Oh yeah, for sure. So, what is Summit Virtual CFO by Anders? We started out as a bootstrap company, no money, and then grew it to about a $12 million company before we end up merging and selling it to Anders. I say $12 million. That's more of a vanity metric. We had about 30% annualized year-over-year growth, and then also about a 25% bottom line. So there's a lot of really positive things that we focused on throughout the journey to develop what we were, and that's what made us super excited to, for Anders to then merge. And so what is that? Virtual CFO services is something that we created back 20 years ago. At that time, there wasn't really anything called that, and so we were more of a pioneer for that. And so what it is, it's not the bookkeeping, the accounting side. A lot of what we do, about a third of what we do is that, where we're bank recs and credit card recs and paying bills and that sort of thing for about a third of our clients. But 90% of our clients, we actually provide strategic advice. And so we meet with them on a regular cadence, whether it's every other week, or maybe it's 3 times a month, or maybe it's just monthly. What we're actually sitting alongside the owner, really kind of helping them and guiding them through what we call dynamic forecasting and modeling, where we're taking things that they can control, whether it's maybe it's a trucking company that repairs trucks, and we're talking trucks now. How many trucks do you have, and how many trucks are you going to repair next month? What do you have in inventory right now waiting to be, and then we translate that to dollars. So that's going to equate to, $200,000 for the month, or whatever that might be. And then we meet with them the next month and say, hey, you only had 8 trucks. You said you're going to have 10. What happened? And then, so then the conversation's going. It's like, well, we're going to have to, the economy or whatever might happen. And then what then happens is, so do we need to adjust our forecast going forward based on 8 trucks versus 10? And it's like, yeah, we do. And so how does that going to impact 6 months from now? How's that going to impact a year from now? And not only on the revenue side, on the profit side, but how's that going to impact cash? And what's the debt going to look like at that point? What decisions did we make today that impacts the future? And so those are the types of things that all these large companies have many people to basically help them to do that. And so we wanted to bring that strategic advice to the small business owner, the business owner that's maybe just starting, or the business owner that's $1 million in revenue or more, or a business owner that's, really struggling with that type of aspect. And so that's pretty much what we do. We help them get to that end goal, whether that's, hey, I want to sell the business in 3 years. What's the end goal look like? How do we create that forecast to make that happen? I want to get a multiple of 6 times EBITDA or whatever that is. Well, in order to do that, here's what we have to do in order to get that done. Are you willing to sacrifice and take the journey with us? And so that's what a virtual CFO does. And like I said, we've been doing it for a little over 20 about 25 years almost.
We'll get right back to the episode in just a minute, but if you've been considering business ownership, if you're already a business owner looking to expand and you're curious about franchising, I'd love to connect with you, answer any initial questions that you have, talk about a specific franchise, and detail the exact process that I use and have taken hundreds of people through to help them understand franchise ownership, find the right franchise for them, and conduct the necessary due diligence. Click the link in the show notes if you'd like to schedule a free, no obligation strategy call. I look forward to talking with you. And now back to the episode. That's part of the mind-blowing part to me, is that you guys started doing this so early. Because I mean, in this day and age, you hear about these type. I mean, you've got a virtual option for almost any position that a small business may need to fill. But to kind of pioneer this 25 years ago but it makes so much sense, right? Like, I deal pretty much exclusively with small business owners.
Mhm.
We're small business owners ourselves, and
Yep.
so many of us, and my wife and I still, at least somewhat fall into this category. Like, we're flying by the seat of our pants when it comes to
Mhm.
to
Yep.
our financials. Like,
Mhm.
now we've got a really good CPA, and it took us a couple years to get to where we had like the right strategic CPA that is meeting with us on a regular basis, and we're looking ahead instead of just completely being reactive. Like, first couple years, it was 100% reactive, right? And it was like oh, we got some money in the bank account, that's cool. Sales seem to be coming in, that's cool. But no real strategic outlook. And I think that's the case for so many small business owners. And so a lot of times, like, the CFO responsibilities, fall to the founder or the owner of the company. And, that's probably fine up to a certain point. But, and then, like, what I typically see is as a small business is starting to scale, a lot of times the first kind of key hire that they'll make is more of a COO type of role, or a general man, like someone that can take more of the operational stuff off of the owner's plate. And it's probably later down the road that they would think about, or even be in a financial position to go and hire a qualified CFO and bring them on in more of a full-time capacity. So you guys are able to come in and kind of fill that void much earlier, and there's no telling how much time and money that it is able to save your clients.
Oh yeah, for sure. And you're right on that transition. It's usually the owners doing a lot of things at first, and really they
Mhm.
probably should be doing a lot of it at first. They need to
To
really
learn
understand
it.
their business. Yeah.
Sure.
Because if they just deflect and say and make that as the excuse on why they're not successful, well, that's the wrong way of going about it. But
Right.
yeah, 100%. We typically see clients when they get to that $1 million mark. They've got
Okay.
this, they've already hired the COO unofficially. Like you said, it could be an operations person or whatever, but
Yeah.
that person's helping with the processes. And we see when they get about the 1.5 million, so about $500,000 more, that's when they starting to look for, hey, I got to get some of this off of my plate. Whether it's the marketing side or the CFO side in this case, and they really can't afford it at $1.5 million yet either.
Yeah.
So
Not
that's what,
not a
not a full
qualified
time. No,
CFO
no,
with a
no. Yeah,
six figure type comp package.
yeah, exactly. And so that's when we start seeing, folks, reach out to a service level that we had, and then at the $5 million mark, if they don't have something like that in place, they're really doing themselves a really disservice, because what happens is what a CFO is going to help you do, or somebody in that position, where you call it a finance manager or director, whatever you call that position.
Yeah.
A lot of folks, like you had said, are going flat because they're just simply doing what they normally do on a regular basis. They don't have really any goals, or they've got goals, but they don't know how to get to them. And what a CFO helps you do, it helps you guide that ship. They create that mark. Hey, I want to get to a $5 million company, a $1 million company. Well, most people don't know how to do that. As a
Yeah.
plumber, I'm not going to know how to do that other than just simply bring on more clients. I hope. I think that's the metric, right? But a CFO is going to really help you kind of guide that ship and get there. Hey, in order to get there, we've got to have this many clients. We've got to build this much. We've got to have this average order size, and really kind of break it down where we can now make strategic decisions based on that. Because again, how am I going to do a 500% growth? Well, I don't know, but a CFO can help you, break it down. And it's kind of like, I relate it to a map, the United States, right? If I lived in Indiana and, Florida, I want to go on vacation in Florida. You know what? I don't need a map to go to Florida. I can just drive south. Eventually, I'm going to get there, right? I might go Texas first because I took a wrong thing, but I'm going to eventually get over there if I've got a general idea where that's at, right? But what a CFO does, or somebody in that position does, they're that GPS system that we now have, and so they're guiding you to that in the quickest and the best route.
Most efficient manner.
But
Yeah.
they're also guiding you around the obstacles, right? You got the road closures that pops up. The GPS says, "Hey, take this route. It's a quicker route because you've got delayed traffic." Well, that's what a CFO does as well. It helps you guide you through those obstacles, because it's really easy to run a company very successfully until it's not. And,
Yes.
and that's
Totally.
and that's when you need the help of somebody like that. It's no different than a doctor, right? Heck, I want the best doctor. There's a lot of doctors that can just do the work. There's a lot of med school people that can do the surgeries, but when something goes wrong, I want the best person in there figuring it out, right?
That's
and,
right.
and that's what the difference between a CFO having that and then having yourself in that position, or our best buddy from whatever that's been doing it, helping you grow the company.
Yeah, your brother-in-law that's kind of helping out on the side. Yeah, I mean it's a common. I think I see this all the time. With people that I work with that end up buying franchises, they can get to a lot of times it is that kind of $1 million mark pretty easily. I'm not gonna say it's easy, but they can get there on their own without having to go out and hire other like C-suite type positions. But that's about as much capacity as they have as the owner to kind of have their hands on everything. And it's a hard thing, I think, for a lot of business owners to make those decisions to delegate and start handing off some of these critical things. But I love your map analogy because it's spot on, with what a good CFO can come in and do. And so much of it is, in the beginning, I imagine defining metrics, right? And setting targets based on those metrics. Like, I think this was before we started recording, but used an example of like a trucking company, right? And how you would, come in and break down, revenue by truck per year, right? And so you can kind of use that as a way to say, all right, well, if we have 8 trucks today, and we add 2 more trucks, what should that put us at in revenue by the end of the year? I see that in a lot of the franchises that I work with, especially things that are in like home service, home improvement. It's trailers, rigs, trucks. So all the financial projections are based on revenue per truck per year and things like that. And without those metrics, you're totally flying blind in terms of any projections. So is that something that you find with most of your new clients when you start working with them? Do they have anything in place as it pertains to metrics, or is that kind of a good starting point for you guys?
Yeah, I would say the franchise clients, they've got the metrics.
Yeah.
They understand the
Yeah.
metrics because it was brought down to them, so they know,
Sure. Yeah.
and they know how to get to the metrics, and so that's the benefit of having a franchise. For
Yeah.
the majority of the clients that come in, they have no clue.
Yeah.
They just know that they've been running a successful business. They priced it right. That's a lot of times that's what caused you have success. You
Sure.
had your pricing right, and again, they're at a point where they're either to the point where they feel obligated because now they've got a staff of 20 people, and 20 people just doesn't mean you're responsible for 20 people. You usually have spouses on there. So now you're at 40 people. They've got
Family.
kids. So now you're at 100 people. So you've got a huge fiducial responsibility now, or you feel that because now I'm affecting the lives of 100 folks. And so it's like, wow, now I've got to get that person. So to answer your question, most of them do not have the metrics, do not understand the metrics, but they're in a position that they finally are realizing, hey, I need more than just me doing this and taking ownership of this, because I don't want to mess anything up. I don't want to end up in Michigan and trying to go down to Florida.
Yeah. What are some of the other, like, I don't know, low hanging fruit that you see with a lot of your new clients when you first start working with them?
Yeah, I would say one of the biggest things is just making sure that they have their financials in a solid position. Whether that's
Right.
because what happens is a lot of time they'll make decisions based on wrong information, and that's never good. I remember having the trucking company in particular that I gave an example is a true life example in which they were running a lot of their revenue through equity. We had no idea that was happening, or they had no idea it was happening because no one was looking at it, because that's what the default was in QuickBooks, is to this opening balance of equity, right? And so they were running it through equity, and we're thinking, wow, that they're not doing well. Their revenue is way low. Their expenses are high. Their bottom line sucks. And so with that, I was like, well, so we're doing reactionary things based on that. And when they allowed us to have control of their accounting, because at that point they didn't, it was like, oh no, and it became another issue because we were advising them on different things. And then once we pushed that up to revenue and they had this giant net income, their tax situation was like out of control. It was like, oh no, they're going to owe a ton in taxes.
Yeah.
And we didn't find that out until the end of the year. Whereas we were advising them because again, they had bad financial information. So I would say the number one thing is having that financial information. I would say number two is having enough cash in the bank to make decisions. And what I mean by that is, how much cash should you have in the bank? Well, a typical service-based business should have 10% of the revenue in the bank. pretty easy to
Okay.
calculate.
That's a good target.
Yeah, $300,000 in revenue, you should have 30 grand in the bank. $1 million in revenue, $100,000 in the bank. And you're thinking, well, that's a lot of money to have in the bank. Well, in reality, that's not. That's really if you go through the formula, that's really what your cash flow cycle is for most firms is having that money in there. Because what that allows you to do, it allows you to make timely decisions. And what I mean by that is, like during the pandemic, we had, our average client has about 15% of their revenue in the bank, to give you an idea.
Okay. All right.
And during the pandemic, when everything was really going sideways and people were uncertain and everything, a lot of folks made knee-jerk reaction decisions that either were really right or really wrong. And it was because they didn't have the cash in the bank to make that. They didn't have the cash in the bank to sit back, relax a little bit, figure out what's going on, and make that decision. Whereas most of our clients, it was not a big deal. It was a big deal, but it wasn't as big of a deal for them because they could take a week where somebody else had to take a day or a moment. They could
just kind of evaluate.
Exactly. Evaluate, see where things are going, know that they've got some cash reserve they can eat into a little bit before things really go wrong, type of thing. And it just made the decision making a lot easier, and it made the decision making informed. And a lot of them were able to take advantages of different opportunities that folks that didn't have that cash were. And so cash gives you the opportunity and the flexibility to make a solid decision. But when I say having 10%, and that's if you're very risk adverse. If you're a risk taker. If you're not a risk taker, then you probably went closer to have maybe 20 or 30%.
Sure.
And 10% equates to about 2 months of expenses. 30% is about 6 months. And so it really depends on really how much risk that you want to take. But that doesn't just mean that the money is just sitting there and not doing anything. You want to have about 2 payrolls in the bank. Again, everybody can calculate their 2 payrolls, have a good idea what their operating account needs to have in there. The rest needs to go into some sort of cash reserve account where maybe it's a high interest checking account making 4%, or something that's super liquid that they can move money back and forth.
Get to it quick, but it's not just sitting stagnant.
Exactly. Making some money on their money. And so, that's I'd say the low hanging fruits. Those are the 2 biggest ones. I would say making sure your financials are dialed in. And then the second one is having enough cash in there to make decisions.
We'll get right back to the episode, but I wanted to quickly share a free resource with you. If you're curious about franchise ownership and want to learn more about how countless people, including myself, have leveraged franchising as a way to create more freedom for themselves and to take control of their livelihood, I've put together an ebook. It's called Franchise Wealth Creation, and it's the perfect starting point for anyone that's just curious to learn more about this whole franchise thing and how I've helped hundreds of other people navigate all the steps involved in understanding and researching franchising. So click the link in the show notes, fill out a short form. I'll send you the ebook. I think it's a great starting point if you're curious at all about learning more about franchising. All right, let's get back to the episode. Yeah, no, that's great advice. And, I think this is something that a lot of first-time business owners or aspiring business owners, the whole accounting, financial, it just freaks people out, right? Because especially if it's not their background, it's intimidating, and I see it in my work all the time. It's one of the things people get hung up on is like, I love the idea of owning my own business. I just have no idea how I'm going to handle the accounting and the financial. So I think this conversation is so important for those people to hear for a number of reasons. I mean, some of the advice that you're giving, right, which is make sure your financials are current and dialed in. Well, that's a hell of a lot easier to do if you start that from day one versus, you get a year and a half in and you haven't really been keeping up with it. You got to go back and do all of this cleanup. Work from the very beginning to build up that cash reserve. And that's going to put you in, it's also just going to remove a lot of stress, right? I mean, and we've been there in our businesses before where, you're looking at the bank account daily and also looking at like what's supposed to come in, what's expected to go out. When you can get to that point where you have a nice cash reserve and a nice cushion, it really frees you up to focus on the things in your business that are going to really allow you to move the needle and keep growing instead of having to worry.
because keep in mind, cash is your lag indicator, right? Of something's wrong. Your lead indicator
Yeah.
might be the your profit's not where it needs to be, and what's causing that. And so, yeah, when you have that cash issue, that's it's not because it's just cash is the issue. It's something else is the issue, and you've got to figure that out.
That's
And
right.
when I was growing up, when we're in our infancy stage of a business, I'm not going to lie to you. We had cash issues. We had profit issues. Here I am. I've got this CPA degree and all this kind of stuff, and it was a struggle at first. And so,
I bet. Yeah.
I'm not gonna come up here and say that, hey, I started this business. It was successful from day one, because I failed many, 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 many times. I mean, I couldn't be the bank when we first started out. I didn't have the money. I bootstrapped it. The only thing I had was like about 10 grand in my 401k at that time, 20 years ago. Not a ton of money. I had to cash it out just to get things started. And with that, when we started meeting with clients and doing the virtual CFO concept that nobody understood, or what are you actually doing? It was like, well, it always came up that, because we were always looking at a 13-week cash for our clients. It always came up. It's like, oh, geez, our expense here, if we delayed our expense for 3 months or 3 weeks, that might help your cash flow. And then the next time would be like, oh, let's delay it, because we really wanted them to succeed, the client to succeed.
Yeah, you wanted them to see value in what you were doing.
Yeah, and we were killing ourselves in the process because we were delaying ours as well. And so I'm like, I had to figure out, how can we figure this out so this isn't the case? Because I wanted to create it where I could actually jump out and never, be a CFO for a client again, and I could build a company of CFOs. That was the idea. And it's like, I didn't want them. I didn't want my team members to be in that position too, where they were constantly thinking, "Oh my gosh," because again, it's not their money; it's that they're pushing back. And so the whole concept was, how could we do this? And so, as a business, when you run into obstacles like that, you got to figure ways around. And the way that we did it is we created a subscription-based billing model, and we did that a long time ago, back in 2007. And with that, it's like, what is subscription-based? Well, back then, accountants bill by the hour all the time. That's how they do it. And some accountants still bill by the hour. Well, we had to figure out, how can we actually do this, create this process so that we could deliver this service to a client without having that obligation of being the bank. Because again, I couldn't afford it. I didn't have the money. I didn't want to, do what you're talking about. Hey, look at my bank account and wait for the next invoice to come in. That was brutal. I didn't want to go through that. And so the subscription-based model kind of cured that a little bit. And what happened was we started zapping their account every month, and it was automatic. There wasn't a conversation point anymore. It was like, here's the fee, here's what's coming out. No different than electric bill. And
when it's predictable. Yeah, it's predictable for your clients.
Yeah, they loved it, because what happened was they stopped showing up to the meetings when we were billing hourly because they were embarrassed. It's like, I know I owe you money. I'm embarrassed. They made excuses. They pushed it off. And it was like, well, then that was, it was counterproductive. Then we couldn't help them out if we weren't in the meetings, and they felt obligated. So it was one of those
just creating this tension point between you and your clients.
Yeah, exactly. And so we had to create that. And so that was an obstacle that we had to figure out how to overcome. And we did it by creating a subscription-based billing model. Clients loved it so much so that it was one of the biggest things that we could have ever done, because they're like, hey, can we meet more often now? Instead of just monthly, can we meet weekly? I'd love to.
Because they're not worrying about the cost.
The cost was out. Yeah. And so we said, okay, great. And so then we changed our structure. Instead of billing them or invoicing them or zapping their account every month, we did every week. And so Mondays are my favorite days, because that's when we zap everybody's account. Yeah. So it's a Monday. They love it. We meet with them maybe twice a month, maybe 3 times a month, maybe once a month. We still zap their account every month. And clients love that predictability. They knew that they knew they can call us anytime, because they knew they weren't on the clock every time, because it was just simply a flat fee, and it was great. It was so great that initially the accounting side, somebody turned us in and said we couldn't zap people's accounts electronically, and it was unethical. And it's like, this was before Netflix and all that kind of stuff.
Right. Yeah. This is before it's as common as it is today.
Yeah. And of course, we went flying colors there because you have the right things in place. But my point there is that when you run into those obstacles, hey, what is the obstacle that's holding you back from success? Figure out let's think outside the box. How can we do it? I don't care if the industry is doing it that way or not. The industry wasn't doing it the way we were doing it. I don't care, if there's things in the way, maybe it's myself in the way. how can we get around that? And then
Yeah.
just take the leap of faith and do it and see what happens. My business partner, Adam, Adam was my number one hire right out of college, and it was the best hire I could ever have because he's my partner today. And we wouldn't have been successful without having the two of us working together. He became a complete partner really soon after we hired it. And the nice thing about Adam is that I'm the ultimate optimist. He is the ultimate, I would say. He calls himself a realist, but I call himself a pessimist. And if he's listening to this, he knows exactly what I'm talking about. But he's like, hey, if you do that, Joey, you are going to lose all your clients. We're going to go bankrupt because nobody's going to allow you to take money out of their account. Blah 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 blah. And it's like, well, let's just try it and see what happens. Yeah. And we did, and it's like, oh. It worked. And then it was like monthly. And it was like, then we say, hey, let's do it weekly. And he's like, no one's ever going to let you do that. And again, we tried it and it worked. And I like to give him as an example because he is the industry. The industry was telling us no one's ever going to do this. No one's ever going to allow you.
This isn't how we do things in this industry. Yeah.
You should give advice to people. Nobody's going to listen to that. They don't want that kind of stuff. And it's like, so you have to kind of think outside the box and really be creative and really just take that next step. You talk about franchises and my father-in-law is a perfect example of this. He's lived in Leo, Indiana, a really small town for a long time, for basically all of his life. And there was this corner place. He's like, hey, I would love to put a McDonald's there. And it's like, that would be a great thing to put in there, because again, he doesn't have to really learn everything. He can just kind of take over a playbook. And he was talking about it. He talked about it for probably 10 years, the first 10 years of our marriage, how he was going to put a McDonald's there. And eventually the McDonald's went up and it was great. And it was successful and it was awesome. Yeah, he called it perfectly, but he didn't do it.
Yeah,
he didn't take that step. He didn't take that risk. And then McDonald's is still there 20 years later, and it's probably one of the most successful McDonald's. And and it's because he had the idea, but he just didn't take that next step and actually execute on it. And I think that's the nice thing about entrepreneurs. A lot of entrepreneurs will take that risk and do it, but there are some that are kind of still holding themselves back because maybe they weren't an intentional entrepreneur. Maybe they started something and just kind of grew into a company, and they're like, oh, I gotta figure this out. And so I would say for a lot of folks out there is, don't be afraid to take calculated risks, especially if it's going to be something that's holding you back from success right now. And at that point, it was a subscription-based billing model. It was the way that we build our clients. Kind of funny, but the way we build our clients, that traditionally everybody builds their clients that way, was holding us back from being super successful. I would say another thing is that being remote. We were one of the first financial companies ever to go remote. We've been remote since probably 2012, 2013 as a company, and with that, we got the idea from a creative agency that we've been working with, a marketing agency, that they were fully remote from day one. They had 60 folks all across the world. It was great. It was one of our first virtual CFO clients that we couldn't actually walk to their place, because they were in Rhode Island. We were in Indiana at the time. And it was like, hey, how can we take this idea into the financial space? And it's like, no one else has ever done it before. There was only, at that time, there's only 25 companies in the world that were fully remote. And I went to a conference with it and met all these folks. It was like, wow, this is really great. And it's like, we could do this. And so again, I took it back to at that time we had 18 folks on the team. I took that back to the team. It's like, hey, we're going to go remote, guys. This is great. We're already working remote with our clients. This is going to be awesome. And every one of my employees said, no, we can't do that because we don't have internet. We don't have this. Clients want to shake our hands, all that kind of stuff that you heard pre-pandemic, and it was like, so now what do I do? Do I take that risk and lose everybody? Well, I didn't. I chickened out. Here I'm telling everybody to take that risk. I didn't take that risk. But what I did is I thought, what? I'm going to make this the best experience for my team. I'm going to build onto my building. That I own. I'm going to demolish everything inside, make the offices really cool, and they're just going to love coming to work here. And so I did that. It took about 6 to 8 weeks for me to do the construction. I kicked everybody out of the office for that time while we did the construction. And guess what? Everybody was like, this remote thing's kind of a cool thing, because I forced them to do it, right?
they got 6 to 8 weeks to get used to working remote. And
it's like, no, they didn't come back. So I'm like, now what do I do? I just spent $100,000 on
that's
this.
Funny, but not funny at the same time.
Mm-hmm.
Yeah, man, those are both such good examples of sometimes you just got to try things, and definitely don't, let the status quo of the industry that you're in dictate how you do things, especially if you've identified, like you did with, billing your clients, that there's a friction point. Think creatively, think outside of the box. Don't be afraid to, try something new and take a risk. And, I hope a big takeaway for the listeners, especially if you fall into that aspiring entrepreneur category, because, like your father, was it your father or your father-in-law? Yeah, like your father-in-law. I talk to a lot of people that they talk and think a lot about owning their own business, but they just can't quite get up to that line to actually take the leap. And that's, look, it's not for everyone. And that's perfectly fine. But I've also helped a lot of people get into business for themselves. And one of the first things I commonly hear is, man, I wish I would have done this 5, 6, 7 years ago when I first really started thinking about it. But you, in order to do it, you have to get comfortable with this mindset that you're not going to have it all figured out when you start. You're not going to have certainty on what the outcome is going to be. You're going to have to, and that's not to say just jump, right? Like, we're talking calculated risk here. There's lots of ways that you can do the due diligence on any type of business opportunity that you're considering. But it's not an easy thing. And that's why, not everyone is a business owner. But I think in this day and age, for a lot of types of businesses, it's almost easier than it's ever been in some ways to, um, become an entrepreneur and start your own business. But I'm curious with you, Jody, because I mean, you guys were really ahead of the curve with a lot of these things. Subscription model, going remote, the virtual CFO model in general. How did you get to that point? So you were a CPA before. What were you doing prior to starting? What was the inspiration to say, hey, there's all these companies that need, this kind of virtual CFO help?
Yeah, it was kind of a small journey. So I went to school and originally to be an economics major. I thought, hey, finance was what I wanted to do. I went down to Indiana University and I thought this is a great school for it. And then I realized that if I did that, then I had to move to like a New York City or a Chicago to be on like a stock exchange and that type of thing. And I like, wow, I really didn't want to move to a big city like that. I wanted to be in a city, but not a giant city. And so I thought, hey, let's what else could be, what other profession could I go into? And it was accounting. I thought accounting is something that, if I didn't like it, it's something I could use personally and go really anywhere else. And I thought
Yeah.
this is a great thing to do. And so I jumped right in. I got accepted to a big public accounting firm. I worked in there. I busted my butt and I hated it. It was brutal. It was like you had this tax season and it was a compressed time where I'm working 80 hours plus a week
Yeah.
and it never was enough. And it was like, after that first year, I was like, wow, I don't know if I want to do this again. Then I started getting sick in December, thinking, oh my gosh, what's going on? I'd go through the same thing. After the
Yeah.
third year, I'm like, no, this is not for me. And actually, to a blessing of mine, the managing partner called me in and said, Jody, you're never going to be successful at what you do. Your personality is just not an accountant personality. I'm going to let you go. It was like, what? Here I've studied to be a CPA and I'm went to college for it. And it's like, that wasn't what I was going to be. And so then it was like, well, now what do I do? I thought, well, I'll go into the corporate world. And I did that. I went over to the corporate world. I worked for a $250 million manufacturing company. I did all their cash movement, their cash analysis. I did their taxes. I did everything for them. And initially I'm working, 50 hours a week. Again, I'm like, okay, so I'm working not 80, but 50. I'm thinking this is good. But as I started figuring out how to really make the job easier and use processes that were never in place and really optimize the workflow, I got my job down to about 20 hours a week. And then it was like, okay, now what? This is boring. It was horrible because at lunch, I'd take longer lunches because I didn't know what to do. So I'm like at the golf course a little bit, chipping on the green. And then I come back and I'm like, this is horrible. And then the manufacturing company started going through a layoff situation. And it was like I was part of the committee. And it was like, well, I felt super bad because here I am dictating the future of all these people that have been there for 20, 30 years. And, I was myself really kind of bored. And so I talked to the CFO at the time and said, hey, I think I'm going to bow out myself. I've got an opportunity. They're like, no, you can't do that. I go, the only way you can do that is if you take us on as your first client. I'm like, boy, that'd be great, So
Done.
so I actually did they actually gave me their $30,000 a year tax return, and I use that as kind of as a seed for my to start my business, and
Wow. That's
with that.
awesome.
Yeah, so with that, it was kind of an accidental thing where I went to school to be one thing. I tried it; it wasn't working. I didn't have that mindset, and now I realize a lot of entrepreneurs in that same thing. They're always it's they just an employee is just not meant for them.
Yeah.
Their
Yeah.
mentality is it's not them. And I realized that pretty quickly when I was at Crow, the large CPA firm, and then Ray Magnawire, the manufacturing company, that both were in the accounting field, but both were not something that I just really enjoyed doing for somebody else. I had to do
Yeah.
it for myself and really kind of have that leap and be able to take the risks that neither one were willing to take, at my level. And so that's kind of how I started it. And then
Yeah.
like I said, I had no money to doing it, and it was kind of silly. It's I bought at that point I bought a house, and you didn't have to actually have I can't remember what they called it, but you didn't have to actually have verification of income back then. And I bought
Yeah.
because I couldn't afford, and then I left and started my own business. And it was like, and my wife actually did the same thing at the same time. She was an attorney, and she worked for a couple law firms, and she started her own practice the exact
Wow.
same month. And so both of us, no money, no job, two kids. And so with that, but we always had the idea that, hey, we were going to be successful. This was going to be what we were going to do. We're going to do whatever it took to be successful. And so we didn't have a fallback plan that a lot of folks have. We
Yeah.
didn't have money from family that could help us out. We
I think that
truly,
helps.
yeah. And I think that was probably one of the biggest reasons we were successful, because we didn't have plan B. Plan A
Yeah.
was going to be it. And we were going
I
to
think
figure
that
it out.
helps with motivation and just not giving up when the times get tough. And like I'll point this out to people from time to time. When we're talking about the pros and cons between investing in a franchise versus starting your own thing, and a lot of people point out, well, to buy this franchise, I have to pay this big upfront fee, and then I have to give the franchisor a percentage of my revenue. And there's so many different ways you need to look at that and evaluate that. And I say it all the time on this podcast. Not all franchises are created equally, and there's a bunch of franchises out there that nobody should invest in because the value is just not going to be there. But in one, like, I know for us, when we bought our first franchise, which wasn't a super capital intensive deal comparatively speaking, we needed about 110,000 total in startup capital. That included the initial franchise fee, our startup costs, plus a decent chunk of working capital on hand once we opened. That initial franchise fee, which I think it was like $45,000 at the time, something like that. That was a hell of a motivator, right? Like, there's no way we were like going to throw our hands up and quit when things got tough, because we just written a check for 45 grand to go and have the opportunity to build this business. Whereas, like, I've seen people, start something on their own, but they didn't really put a whole lot of money into it. They're kind of bootstrapping it. And then 6 months later, they're like, yeah, I don't know. I'm not really doing that anymore. It was harder than I thought it was going to be. So I think that's one way that, whether it's a franchise or just anything where, if the proper motivation is there, it can really be a driver and a force multiplier. But that's a cool story, especially that you and your wife quit corporate jobs at the same time. So does she have a virtual law firm that bills clients on a subscription basis today?
Yeah, so hers was a little different because her practice was in the Medicaid field, and so
Okay.
the folks that coming in, they really didn't understand the virtual concept at all, and so she
Yeah.
had to actually have an office to do that. But she used a lot of the processes that we actually created at Summit with her practice and streamlined it to where she eventually sold her practice as well, and
Awesome.
to get good money for it too. So yeah, so she used a lot of it and piggybacked off of that. Kind of backing up real quick here, and you talk about the strength or the roadblocks that might come into play. For the first 2 years, I never got a salary. I didn't get any money. of the business. And I didn't go into it thinking I wasn't going to get that. I went to it thinking, hey, this is
Right.
going to be a money making thing. And
Sure.
it was a couple years before, and I was living off of credit cards. I was doing all the things I'd recommend never to do to any client. But I was doing credit cards. I was trying to figure out how to do this. I was paying my partner Adam. I was paying him a salary, so he didn't experience that issue. But for me, it was like just living on those credit cards, and it would have been super easy for me to give up at any point in that journey. And thank God I didn't do that, because $12 million a year later, it's a different thing, and so I would
Yeah.
emphasize dramatically that, hey, you're going to have those roadblocks in the way. Just you got to figure out ways to get around them. You got to make them very small. And for me, I didn't have the cash in the bank that I televangelize to everybody. If you do have that cash in the bank, those roadblocks are dinky pebbles, not these big
Yeah.
boulders that.
Yeah. They're not nearly as stressful and can't, derail you as much. But yeah, man, it's such a good story because, entrepreneurship's hard, right? Even if you're coming into it with plenty of capital, even if you're, buying a franchise where there's a playbook and a blueprint and all types of processes and support already in place, like it's still freaking hard. And there's still going to be all types of things that don't go the way you thought it would or come up as a surprise. It's the old Mike Tyson saying, everyone's got a plan until they get punched in the mouth. Like you're going to get punched in the mouth, as an entrepreneur, and probably more than once. But if you have a vision, right, if you really kind of have some goals that you're working towards, you got to focus on that. You got to get clear on them first, and then you just got to stay focused on that. And yeah, I'm sure there was many times where you could have given up or could have considered giving up. And now your wife sold her practice. You've sold or merged your business several times. One thing I know is that businesses with a predictable recurring revenue model, like a subscription basis, tend to command a good bit higher multiple, right? So I imagine you've done incredibly well, with the acquisitions or mergers that you guys have gone through so far. You could have given up, right? And said, you know what, I'm going to take the easy route and go get a job at another big company and just kind of, I know that's not what I want to do, but that's the safer play, and I'm just going to suck it up and do that. And I think unfortunately that happens to a lot of people. Um, yeah. So, man, we could talk about this stuff for hours, but I know you're a busy man. Did want to make sure people know you've got a couple books that you've written. You guys also do a couple of different podcasts. Where can people go if they want to hear more from you and learn more about Summit Virtual CFO Group?
Yeah, great question. So, if you ever Google just Summit Virtual CFO, there's a lot of things that will pop up. We're very transparent in how we do things, what we do, and we give a lot of great information out there. YouTube videos to web, to basically white pages to really everything there. If you want to listen to our podcast, just you Google Virtual CPA Success Show. We
Okay.
do podcast there, and that's geared more towards service-based companies. We have some digital agencies in there, marketing agencies. We actually have a law firm one too. We can piggyback off on that, and a lot of different things there. My book,
Awesome.
if you're interested in taking a look at my book, just go ahead and send me an email at Jody, Jody at summitcpa.net. Again, that's .net, not .com. I couldn't afford the .com back then, so use .net. And give me that. Just shoot me an email, and I'd be happy to send you a link to the book, or you can just go on Amazon or Kindle
Awesome.
to get the book too. It's called Digital Dollars and Cents. It really breaks down the key metrics that a service-based company needs to understand and know in order to be successful. And it's a lot of things that we actually found at our processes, and we call it profit-focused accounting, that we
Okay.
basically evangelize to all of our clients, and that's the four main pillars of that: from how much cash you'd have in the bank, we talked a little bit about that, to production metrics, to financial metrics, to the actual pipeline metrics. All four of them need to actually work together, and that's what that book talks about. I'd be happy to send you a free link to that, so you can get caught up on that as well.
Yeah.
And then, like I said, Jody at
Awesome.
cpa.net. That's really how you get a hold of me.
We will make sure all of that is in the show notes, make it super easy for people to find. But Jody, can't tell you how much I enjoyed the conversation, and would love to invite you back to the podcast again at some point. I think we could probably do 5 or 6 of these and still not run out of things to talk
I
about.
think
So
so.
I know I learned a ton talking with you today. Know the audience did as well. For those of you listening, go check out the book and the podcast. And if you're a small business that knows you need to get some of these things in place, reach out to Jody and his team over at Summit, and they will get you squared away.
Yeah, thanks, Wes. This has been a great time.
My pleasure. Thanks, everyone.